Inflation came in harder than expected in the last print. You said the Fed is stuck. What do you mean by that, and what would they do?
They're looking at a situation where the economy is growing faster than they would like because of inflation still well above their 2% target. Labor costs are cooling off, but they haven't really collapsed. There's no real pressure on the Fed to cut because of slack labor markets. We're ending the bond rally of a lifetime. The yield on the 30-year bond was 14.6%. Now it's now it's a little over 3%. I don't see any area that is really just panting to be bought.
I'm joined once again by renowned economist Gary Shilling, president of Gary Shilling Co. He was on the show last year in late October, and we're talking about the direction of the Federal Reserve and a potential recession. Have things changed? Is this time different? Let's find out. Dr. Shilling, good to see you again. Welcome back to the show.
Glad to be with you again.
Let's start by talking about the stock markets. Have stocks run up too much? Have we seen the end of the bull rally, Dr. Shilling?
I think we probably have. Uh, if you look at the cyclically adjusted price earnings ratio put together by Professor Schiller, good friend of mine at Yale, it says that stocks are now 55% above the long-term norm. And that norm goes back to 1870. Now, of course, you can always say this time it's different, but as Sir John Templeton said, those are the most dangerous words in the English language. This time it's different. There are times when things really change, but you've got to have very strong evidence
Mhm.
for that. And I don't think you have now. So it's hard to avoid the conclusion that stocks are very expensive. And of course, you've had an awful lot of speculation, and this is because I think people are not they're not seeing the kind of performance in the basic economy that gives them assurance. So it's kind of like running the Kentucky Derby, 3 minutes
Sure.
of spectacular action. But I think that's where we are right now, and stocks are very expensive, and there's not much room on the upside in my view.
Dr. Schilling, the Bull's counter argument to that would be, well, the cyclically adjusted PE was high even before the start of the bull rally last summer. And so valuations don't necessarily mean that, well, high valuations don't necessarily mean that prices won't run up even more. How would you
Yeah,
respond to
well,
that?
that's the argument that history is no longer relevant. And again, I just don't think there's compelling evidence to the contrary.
Is there any particular sector that you find more overvalued than the others?
Well, the tech sector, of course, has been extremely overvalued, and it's had some considerable cutbacks recently. Many of these stocks, of course, were the darlings of the pandemic. People were at home and they couldn't go out and eat and so on and so forth, so they were playing computer games and so on. But a lot of these tech stocks have really gotten out of hand. If you look, for example, at Kathy Wood's ARC complex, I mean that's been a unbelievably speculative situation, and that has cost investors $14 billion since its peak, the sell off. So these are areas that are highly speculative, and it doesn't mean that you can't make money out of them if you're very, very clever and can pick the right points to enter and exit. But I think when you see that kind of spectacular run up, what it tells you is that people don't have confidence in the basic economy. They're looking for the frills, the outward flourishes, and that's where you get to the speculation. You get things like Bitcoin, where there's absolutely no substance to it, and yet it has a huge following, and now ETFs on Bitcoin, and it really tells you me that we're a long way from reality.
I'm going to come back to this reality in just a minute, but looking forward now, Dr. Schilling, do you think that the next decade of stock market returns will yield the same kind of returns as the previous decade?
Uh, Probably not. We're looking at no doubt slower economic growth. I don't think you have the prospects of expanding price earnings ratios, probably contracting. So I rather suspect that stocks in the next decade are going to be much more muted in performance.
And do you think that another higher yielding asset could take the place of the fund manager's preferred asset holding?
Well, there's always a search for other alternatives. I mean, I tend to think treasuries are relatively attractive, but they're not as attractive as they were in the early 80s. I mean, back then we said we're entering the bond rally of a lifetime. The yield on the 30-year bond was 14.6%. Now it's now it's a little over 3%. I mean, it's had a huge rally. I think it could rally further, but you don't have that spectacular opportunity there. I don't see any area that is really just panting to be bought.
And the search for higher yields will ultimately lead to bonds, do you think?
Yeah, that's where they tend to sell more on the basis of yield. Um, of course, there are other areas that have come and gone. Commercial real estate was one where there's been a lot of interest in yield there, but that, of course, has gotten into big trouble recently with excess capacity, people staying at home, empty office buildings, and real financial woes for for lenders and financiers in that area. But I don't see any other areas that really look attractive.
Before we continue with the conversation, let me tell you about today's sponsor, Kudos. Now, what if I told you there's an easy way to turn your everyday purchases into free flights, hotel stays, and incredible travel experiences? Well, it's called Kudos, a free AI-powered wallet that helps you maximize your credit card rewards and benefits when you shop online. Kudos makes it easy for you to earn more travel rewards by automatically suggesting the best credit card to use on each purchase to ensure that you always have racked up the highest amount of miles, points, or cash back. And with Kudos partnership with the Points Guy, you can also discover new credit cards and receive access to the best welcome bonuses possible. But Kudos doesn't just help you earn more rewards. It also makes shopping a breeze by auto-filling your credit card info with one click. Kudos is so easy to use. It's like Apple Pay, Honey, and NerdWallet all in one. The best part, Kudos is completely free. No hidden fees, just more cash back into your own pocket. It's no wonder that Kudos is trusted by over 200,000 shoppers and was awarded the #1 app to multiply your rewards by card rates. So if you're ready to start turning your everyday purchases into free travel, just click the link below or scan the QR code here and sign up with the code David Lin to get $20 back after your first eligible purchase. Start getting more out of your credit cards with Kudos. Okay, let's talk about inflation and ultimately the Federal Reserve and central bank policy. In 1998, you published a book called Deflation: Why It's Coming, Whether It's Good or Bad, and How It Will Affect Your Investments, Business, and Personal Affairs. It's a very interesting concept how we're talking about how you wrote about deflation from a different lens. Usually, when we think about deflation, we couple that with some sort of economic recession or depression, but that's not what you were referring to. You were talking about a potential new scenario, yes.
Yeah, and I made clear in that book that there are two types of deflation. I mean, deflation is a situation where supply exceeds demand, and you can get there with either supply increasing or demand condensing. Now, there have been times, late 1800s, for example, with the American Industrial Revolution, huge increase in supply with all the productivity in new technologies. In the 1920s, you had a burst of growth from new technologies. Telephones were widely used, radio. These were new technologies, so you had a huge increase in supply. Now, in contrast, the 1930s was a question of deficient demand. So you can get to deflation, say, either with excess supply or with deficient demand. I think now it's been a little bit of both, and that's what I was writing about in that book and subsequent books I've written on that. I think it's been excess supply in the sense that you have uh, globalization, which is not dead in my view. It's moved out of China. It's more in Vietnam. It's in Bangladesh. It's India is the 800-pound gorilla in the room. Uh, that's a huge increase in supply, very anti-inflation, if you will. So I think you have that, but on the other side, you say, where is demand? Well, in an aggregate sense, you don't have strong drivers of demand. You've got the post-war babies who basically are not in a big expanding mood in terms of spending. They've got their houses, and right now they don't want to move because if they did, they'd incur higher mortgage rates, as we all know. Uh, so you don't have a strong demand picture right now. So I think you've got downward pressure on prices coming from both supply increases and relatively weak demand.
And just to be clear, were you referring to deflation of consumer prices overall, the CPI, or deflation in asset prices?
Yeah. Well, of course, that's in the eyes of the beholder. I mean,
Okay.
right now, anybody involved in commercial real estate would say, "Oh yeah, I know what deflation is all about. I'm looking at it every day." Uh, but yeah, when you talk about deflation, to see deflation in terms of the CPI or the Fed's preferred personal consumption deflator, um, you're really talking about a broad sweep. And one of the important areas there are services. Services are now much more important than goods. As economies expand, you spend more on services. You can spend more on goods, but not as much. You can put only so many cars in your driveway, but you can spend an awful lot of money on travel, recreation, medical services, and so on. So services are a lot stickier in terms of deflation. I mean, when's the last time you walk into a barber and say, "Can you give me a lower price on a haircut?" Now, I don't have to worry about that, of course, but but you do. But services are inflation is a lot stickier, and that, by the way, is what really is of concern to the Fed right now, because the inflation area is really in services, and look at right now the wage increases in the service industry year over year are running 4.6%. Well, that's a long way from the Fed's 2% in inflation, unless you had tremendous productivity growth, which you don't.
Is that indicative of a strong, bustling economy when the services industry is seeing inflation? Would that potentially indicate that people are spending a lot of money, discretionary spending?
I don't know that it's a bust, but it certainly is it certainly is a concern to the Fed, and it's one of the reasons where I think the Fed is pretty much stuck. The Fed at times, if you look back, you look back a couple of years ago, the Fed was determined to curb inflation. They were late to the party, and so they jacked up rates from basically zero to now, five and a quarter, 5.5%, the Fed funds rate. Uh, they were they were leading the charge, if you will. Now the Fed is really just watching the data. They're not leading, they're following. I think you've seen a decided shift there. So the Fed is definitely following, and it's going to be what happens to inflation, and inflation is just not coming down that rapidly.
Is
And
there
and I'm sorry.
Is there for you, Dr. Schilling, a golden inflation rate that would indicate to you the optimal increase in living standards year over year? In other words, not too low, not too high. If too low, we get Japan in the 90s, too high, and we get Venezuela, Argentina, Lebanon, and so on and so forth.
Well, everybody's looking for that Goldilocks solution, that golden mean. Um, it isn't an inflation rate per se. It's inflation relative to expectations. In other words, if you have 3% inflation, but everybody is worried about prices escalating and going up to 5 or 6%, that's a very different story than if people aren't worried. Now, right now, as a matter of fact, if you look at the surveys by the New York Fed and other bodies, there really aren't inflationary expectations. People in general are looking at inflation over the next 3 to 5 years in the 2 to 3% area. You don't have that kind of expectation, and those expectations are important because they can be fulfilling. If everybody expects prices to go up, they tend to buy ahead. They buy ahead of need, and that strains capacity. It strains inventories. Prices go up, suspicions are confirmed, people buy even more. It's a self-feeding kind of cycle. That's what we had back in the 70s, and the Fed is very concerned about it, but that is not the case today.
Are we headed for deflation then today?
I think in a sense, yes. In a sense, yes, because you do have very strong excess supply. As I mentioned earlier, globalization is still very much alive in my view. Um, and you just don't have a big source of demand. You got nothing like housing the post-war babies 3 or 4 decades ago. You got nothing like the subprime mortgage bonanza where everybody was out buying houses. There's nothing right now that gives you that strong demand. So I think that you do have more deflationary than inflationary pressures.
Do you think that the asset run up that we've seen over the last 13 months or so with stocks and Bitcoin and in some cases residential real estate as well will lead to a spending boom over the next 12 months as people cash out?
Oh gosh, I don't think so.
No.
I don't think so. I don't think there's any reason to believe that.
Has there historically been any relationship between asset prices running up and then some months later consumer spending going up? Are they coincident? Are they leading and lagging? Any relationship at all?
Not that I'm aware of. The usual problem is when you have a big boom in asset prices, you get a bust. Uh, but that's really in the financial area as opposed to in the goods and services spending area.
So this deflation that you're talking about, is this you're talking about a long-term trend, multiple years, or are we talking about later this year, next year?
It's multiple years, and it
Okay,
doesn't mean that you're going to have the CPI going down
sure.
year after year after year. But it does mean that you have a generally a deflationary climate with more times where prices are declining than when they're rising.
One thing that I'm guessing you didn't mention in detail in the late 90s when you wrote that book was probably the advent of AI and how that may have inflationary, or in this case, deflationary forces or factors. As more people get replaced by AI, I think that may, some speculate that may bring wage pressures down. Is that something to be looking at?
Well, it is. As a matter of fact, we do a monthly newsletter called Insight. And by the way, if anybody's interested
Sure.
in a senior copy, be happy to send them one. But wrote one a couple of months ago, looking at all the fads right now, and and uh, and noticing which ones had come to grief and which ones have not yet come to grief. And of course, uh, 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 AI is one of those which has gotten tremendous play, but now is sort of cooling down. Uh, the electric vehicles, of course, is really come and gone. You see a lot of these things, and the real trick from an investor standpoint, is to recognize which ones of these have lasting power, and if so, what's the right time to get involved. And of course, there's a it's always easiest to get involved when the crowd is rampantly bullish on them. And that's usually not the time. That's usually the worst time. But electric vehicles. Hey, I don't know where we're going to end up there. I mean, obviously they're very expensive. The recharging is an issue, but eventually they're going to have a degree of success, but probably not what people were expecting earlier. But it's really a matter of timing. You can't jump in when the crowd is all excited. You got to wait for things to cool off. And I think it was Baron Rothschild a century ago said the time to buy stocks is when there's blood flowing on the streets of Paris.
Is there blood flowing on the streets now?
I don't think so.
No.
I don't think so. And no, we're not there.
Fair enough. Speaking of electric vehicles, I don't think the concern is charging them. I think the concern is taxi drivers getting laid off because we're going to get robo taxis on the street. We no longer will. They will be like the carriage drivers of the 19th century, early 20th century soon. Let's go back to the Federal Reserve, Dr. Schilling. What do you think they may do this year? Remember, inflation came in harder than expected in the last print, and in fact, it's been staying stubbornly above 3%. I'm talking about headline CPI. And so you said the Fed is stuck. What do you mean by that? And what would they do?
I don't think they have any incentive to do much of anything. Uh, they're looking at a situation where the economy is growing faster than they would like because of inflation still well above their 2% target. Labor costs are cooling off, but they haven't really collapsed. There's no real pressure on the Fed to cut because of slack labor markets. So I think the Fed is just sort of sitting there and saying, "Hey, wait a minute, let's see what happens." As I mentioned earlier, that there are times when the Fed is very much the driving force, and that's what happened, of course, after the pandemic and the big burst of inflation that the Fed did not foresee. They were late to the party, and they had a lot of catch up to preserve their credibility, but right now, I think the Fed is they're following the crowd. They're basically sitting there waiting to see what happens, and there's no real pressure on them one way or the other. Why should they cut rates when the economy is limping along? It's growing more slowly, but it's still growing. And why should they increase them? Inflation is there, but it hasn't really exploded. So I think they're just kind of coasting.
So you don't think they're in a hurry to cut rates anytime soon?
No, 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 I don't think so.
Wouldn't that risk putting the economy into a recession?
Well, that's always there, and the Fed very seldom deliberately puts the economy into recession. Although the facts are, if you look at the entire post-war period, with only one exception in the mid '90s, when the Fed went through a interest rate raising campaign, which they have been in the last couple of years, you got a recession. There's only one exception. Now, they very seldom are gunning for a recession. They usually would like to pull off a soft landing, but that's very tricky, and they just have not been very good at that.
Are you concerned about more bank failures? Here's the concern. Here's the logic here. If rates stay high for longer, the commercial real estate sector may see a series of defaults or foreclosures that may lead to regional bank failures on a larger scale. We already saw one a couple of weeks ago, Republic First Bank in Philadelphia, and the concern is that more may happen. What's your take?
Yeah, I think there are more bank failures out there. But the reality is that after last year, early last year, remember that the Fed stepped in to to bail out two banks that were uh, obviously failing, and they've really set that pattern. So we're not looking at a complete collapse in the banking system because the Fed and the FDIC and the other regulators have basically said that they're going to step in and and support banks. Now that doesn't make things easy because what we've seen after Silicon Valley Bank and the subsequent failures, we've seen huge rush out of those banks into CDs, into treasuries, into brokered funds, which are really lethal. I mean, when banks have to borrow with brokers' funds, that's hot money, and that's very questionable as to whether it will stick around. So you have seen decided effects, and I think we probably will continue to see them. But there's a difference between this kind of a slow motion bank crisis and an absolute run on the banks.
Yes, and I did hear that perhaps if bank failures do happen, the federal government, the FDIC, and the Treasury may move in to backstop losses and bail them
Yeah,
out.
yeah, yeah, one
So,
way or the other. Yeah,
so
I
for
think that's it. But that does not restore confidence. That prevents widespread runs, but it doesn't restore confidence, and that's what we've seen with banks over the last year.
Okay, so finally, then, putting everything together, how would you describe your current sentiment towards the equities markets right now? Are you bullish, neutral, or more bearish?
I'm pretty much neutral. Um, I was bearish earlier, but now the Fed is basically sitting there saying they're gonna bail things out if necessary. So I'm pretty much neutral right now. I just don't see any great where our portfolios and our money management arm, uh, we're interested in long-term treasuries because I think that we are going to see lower inflation and eventually Fed ease. Uh, and safe haven effect is very strong there. And the other area we like are the dollar. And again, it's a safe haven kind of thing on a global basis. But those are the areas that we're interested in.
If the Federal Reserve does lower rates at some point, either later this year or next year, while the other central banks around the world, I guess, keep rates where they are, would that not put downward pressure on the dollar with interest rate differentials in favor of the other currencies?
I think the reality is that when the Fed moves, the rest follow
Okay,
the Fed.
I see.
You know, I don't see. I don't think the Bank of Zambia is a very independent global financial entity.
Fair enough. Uh, okay. On that note, are there any particular assets besides treasuries that you're also very excited about?
Well, I mentioned the dollar.
Okay.
Um, I think the dollar is going to continue to benefit, and again, it's a safe haven, and U.S. interest rates are higher than elsewhere, and probably going to remain higher than elsewhere. So you have the attractiveness of the interest rate differential. So I think the dollar and treasuries are the two areas that we're interested
Do,
in.
do you think the 10-year could retrace 5% or will?
I'm sorry.
Do you
I'm
think
sorry.
that do you think the 10-year yield will retrace 5% this year?
It could. Uh, it could.
Okay. Would you put a small amount of money in your portfolio to speculate on speculative assets like cryptocurrencies, smaller tech stocks, Bitcoin, that kind of thing?
Yeah, on the short side, sure.
On the short side, okay.
Oh, of course. This is rampant speculation for goodness. I mean, are you aware right now
Yeah,
that there are options that expire in hours? In hours,
I wasn't
not
aware of that.
days, months, years, in hours. I mean, you talk about out and out gambling. I mean, the guys who found the Kentucky Derby dull are into these vehicles. I mean, this is just rampant speculation. You look at Bitcoin. What is it? It's a fiction. There's no substance behind it that anybody can identify. I mean, you got a lot of speculation out there, and that's what happens when investors are not happy with the basic economy. They look for speculative outlets, and that's what we've had in abundance.
What would change your mind if people had to present to you evidence that Bitcoin had value? What would they need to do to prove that it does?
They'd have to show me where the value is. Where's the value? I mean, there's nothing in the construction of it that has any value. It's entirely a fiction. Uh, I don't know. I don't know anything there that could back it up. I mean, and you look at some of the stable coins earlier, they were supposedly at least had the stability of 100% convertibility into hard currencies, and turned out a lot of those things were run by crooks. I mean, the whole thing is our friend Sam looked like an angel compared to some
Well,
of these guys.
here's a philosophical argument from some monetarist thinking people that a lot of people in the future who may be tired of, let's say, government controlled fiat will seek an alternative form of money outside of government control for whatever reason that may be, or just to escape from inflation. And so they may choose gold, they may choose Bitcoin, they may choose any digital currency they see that is more decentralized. And so the value there is in the potential of people using it as a medium of exchange on a more broader basis. Do you see that potential playing out at all? Is there any
Good luck.
good
Good
luck?
luck.
Okay.
Good luck. I mean,
All right. Any let's close off here. Any advice for the younger folks watching this who maybe want to be who want to be an economist or
oh,
work in
want to
work
be
in your
economist
industry?
now? Now there's a really interesting point. Yeah, I think the economy is very interesting, and it's worth investigating. But the main thing is for people to look at it realistically and to, as I say, not get carried away with fads, to recognize the speculations for what they are, and to look at the fundamental situations. And you come down to the most fundamental of economic reality: supply and demand. And when supply is exceeds demand, prices are pressed down. In reverse, when demand exceeds supply. I mean, some of these very fundamental things. And of course, what happens is that there's a tremendous zeal to find wonderful speculations that are going to make you a fortune overnight, and that's fine. If people want to speculate, again,
What are some of the most common mistakes? That final question. What are some of the most common mistakes that economists have made through your observation? If they consistently get calls wrong, what are they doing?
they're following the crowd. They're following the crowd. Most economists are paid to be bullish, and of course that's a sheep-like approach, and investors have to recognize that. Now, I've had experience on the other side. I was fired twice by Don Regan, president of Merrill Lynch, for being bearish, even though I was correctly so. That didn't make any difference. I wasn't being bullish on America in the Merrill Lynch parlance. So you have to recognize who's paying people. What are the biases? Where do they start from? Everybody claims that they are not biased, but you have to look at, and particularly, where do they get paid? How do they get paid? What's their financial incentive? And
Yes,
start from there.
for sure. Where can we follow your work and learn from you? You mentioned you have a newsletter, a fund.
Yeah, we do have a newsletter. It's called a monthly newsletter Insight. Matter of fact, it's just going to the press next couple of days, and people can get in touch with us with A. Gary Shilling, www.agaryshilling.com, and we can send them a sample copy, and be happy to do so, and they can see what our views are. This particular issue looks at the overall situation, including the investment outlook, and we have every month a rundown of our investment positions,
The
what we like, what we don't like, and yeah, I'll be happy to. Uh,
We'll put the link down below, so please do follow A. Gary Shilling and Co. The website has a list of your services, press media, your newsletter, and also a page on beekeeping. So
oh
there's
yeah.
there's there's pictures of you. Is that you in
Oh
the
yeah,
picture?
that's me. I'm a beekeeper. I'm a beekeeper. Yeah, it's an overgrown hobby. I got about 60 hives, which is a lot, and we give away all the honey.
Oh, you give away. You don't. Does it taste? I don't know anything about it. Does it taste different than the store-bought
Yeah,
honey?
yeah, because the honey taste comes from the nectars that the bees gather, and the bees are very opportunistic. Now, where I am, the nectar comes from trees. All the garden flowers in our town, Short Hills, New Jersey, wouldn't make 5 pounds of honey, but it's trees, and it's three trees. It's basswood, which is also called linden.
Yeah.
It's black locust, which is a tiny little flower, and the third one is tulip, or tulip tree. But the bees are opportunistic, and they mix up the nectar, so the taste of the honey one year are and the color are different than they are in succeeding years. It always makes it interesting. You never know what it's going to how it's going to turn out.
Fascinating. I don't think I've ever met an economist who beekeeps as a hobby, but that's fascinating. We'll talk more about that next time, I suppose. Thank you very much for your time today, Dr. Schilling.
My pleasure. Glad to be with you.
Thank you for watching. Don't forget to like and subscribe and follow Dr. Schilling in the links down below.